欢迎您观看红周刊的面对面节目，我是今天的主持人张小天。我们今天邀请到的是美国上博投资管理公司首席执行官杰森·布莱迪先生。上博投资旗下管理的资产规模超过了490亿美元，他们的股票和债券基金广泛投资于全球市场，尤其是新兴市场。Welcome, Mr. Brady.
It's a pleasure to be here. Thank you for having me.
Thank you. Let's start with the Federal Reserve. In recent weeks, the Fed has been turning hawkish and has caught the attention of global financial markets. So, when do you think the Fed would begin raising rates, and how many hikes are you pricing in?
Sure. So your question is worded exactly right. It's happened only in recent weeks. So the shift has been very dramatic from a Fed that was still discussing inflation, which has now become a problem or has been a problem, frankly, for a number of months. They were still describing it as transitory. Now they're calling it public enemy number one. So I would expect that the Fed will begin to raise rates in March. Markets today are pricing about 4 hikes. But I think what's interesting about those markets is it's hard to price tail risk. It's hard to price more. I would remind all market participants that in the mid-2000s, the Fed began a hiking cycle from 1% rates and hiked at every single meeting 25 basis points per meeting for years. And even that was not sufficient to quell financial market speculation. So I think the Fed will hike more than 4 times, maybe as many as 6 or 7 this year. More interestingly, I think the Fed will begin to not only stop increasing its balance sheet, but potentially start contracting its balance sheet, so-called quantitative tightening. And the Fed themselves are not really sure what that will do to financial conditions. So it will be a time of significant volatility, in my view.
Another signal, the yield of the U.S. 10-year Treasury has spiked dramatically and hit a 2-year high. So what's driving it, and what do you think it would be at the end of this year?
Sure. So actually, what's been interesting is in the context of inflation in the United States that just printed at 7%, the 10-year is today only at something around 185.
Yeah.
Even more than that, the real yield, which is to say the using implied future inflation, the 10-year is still notably negative in the negative 60 to 65 basis point range. So even to be at a point where the market expects long-term inflation to equal the 10-year Treasury level, we'd have to have rates rise again about 60 to 65 basis points. I think there's a few reasons why the real rate remains negative. 1, inflation will calm down somewhat. And 2, again, the Federal Reserve has been buying so many. So my view is the 10-year Treasury will rise up towards 2 and perhaps through 2%, 2.25% by the end of this year. But what will be more important to note is the difference between the 10-year and the longer end of the curve and the front end 2-year and the Fed funds rate. So I believe the curve will continue to flatten, which generally presages more challenging economic conditions.
Yeah, as all this happens, we've seen corrections in some areas of financial markets, notably tech names in the stock market. So in your opinion, which kind of assets are vulnerable to raising rates?
Sure. So sometimes in risk markets and equity markets, people want to buy hopes and dreams.
Yeah.
And sometimes they want to buy cash. And we are shifting from a market of hopes and dreams to a market that's more focused on cash. What's interesting is often in those kinds of markets, people flee for the safety of fixed income. But obviously inflation globally, not just in the United States, is running at a level which makes that less attractive. So what we see on the equity side is a shift towards cash flow generative companies, which incidentally tend to trade at lower multiples and lower prices than the stocks that are selling hopes and dreams.
Mm-hmm. And how about digital assets like Bitcoin?
Sure. So I would say for my portfolio, Bitcoin certainly represents hopes and dreams. While blockchain technology can have a number of different uses, the use case for Bitcoin is really stuck between an investment asset and a currency or a trading asset. So I believe that cryptocurrencies generally will continue to struggle in the context of folks wanting something that is more easily convertible to cash. I will note that Bitcoin, Ethereum, and other cryptocurrencies are still quoted in hard currency terms, which gives you a sense of how people measure their wealth, not in Bitcoin, but in dollars and renminbi.
Mm-hmm. And gold, the price is pretty, higher than historical level.
Sure. Gold has a number of folks have substituted cryptocurrency for where they traditionally use gold. And as such, gold has been a less buoyant asset in the context of very low rates. As rates rise, it will be a challenge for gold to keep up in the context of gold not providing any kind of income. If gold is to rise, it will be evidence that the market believes that central banks, including the Fed, are not going to keep inflation under control. So while gold can be a part of your asset allocation, for me, it's more of an indicator of the market's sentiment on its belief on whether central banks will be successful in lowering inflation.
Mm-hmm. We are seeing a correction of the Nasdaq Composite Index. Maybe today. So, how do you think what would happen next for the stock market? And is there opportunities to buy the dips?
Sure. So I think that in any time of market volatility, there's a moment where investors are selling regardless of the quality of the asset. So correlation in more volatile times tends to rise and go to one. So everything falls or everything rises. In this case, things falling. So that it does and can create opportunities. I don't think we're there yet. I don't think we've actually seen at a broad market level significant amounts of pain and more specifically deleveraging. When there are capital calls, when there is deleveraging, that's when you'll really start to see assets fall in tandem, and that's when opportunistic capital can really be effective over with a long-term time horizon. But that hasn't happened yet.
Mm-hmm. In terms of interest rates, China's are much higher than those of developed economies. So how do you think about the opportunity in China's bond market?
Sure. So not just the level of interest rates relative to other large markets across the globe, but actually the direction of central bank action and policy action. Yeah. So one of the most interesting aspects of both 2021 and 2022 is the big differential in policy direction in the two largest economies in the world. So in 2021, you saw the Fed being very accommodative and Chinese policy being somewhat restrictive, trying to wring excesses from the economy. Now you're seeing some of that switch, right? So the Federal Reserve is now dealing with an inflation problem, and you're seeing some more indications of accommodation from Chinese policymakers. That can and will, in my mind, be a benefit for locally priced Chinese bonds. Where it will be more of a challenge and a headwind is for exchange rates between the renminbi and the US dollar. So that balance will be an important one to strike for investors.
Mm-hmm. When it comes to stock picking in China, what trends or sectors are you looking at?
Sure. So China leads the world in many ways in technology. And we are very cognizant of recent regulatory action, actually both in China and in the United States, around some of these very innovative companies. That said, they are world leading, and their ability to leverage and scale has been significant over the years. So that's one side, but portfolio management is also all about balance. So there are a number of cash flow generative, basic blocking and tackling, basic industry companies in China, which we think can add some value. One of them, frankly, remains, and I wrote about this a number of years ago, but one of them remains from a valuation perspective and from a yield perspective, China Mobile. So think about using names that are very different in character and having that balance as opposed to having only one kind of company or only another kind of company.
And as you know, China has liberalized the financial industry in recent 2 years. As an asset manager with 40 years history, how do you think about the business opportunities here in China?
I think that as an asset manager, as a global asset manager, Thornburg has a lot to offer to Chinese clients with our global expertise. That said, I know of a number of different Chinese asset managers with very extensive local knowledge. So it's our view that we can bring a global investment expertise as China's market becomes more liberalized, as you say. I actually think a number of international asset managers are making a mistake to try to compete with a very robust Chinese asset management industry in managing Chinese assets for Chinese people and institutions. I think that's going to be much more challenging and frankly, a little presumptuous in the context of their history versus the local asset managers. So we continue to look for opportunities to partner in the context of our global investment expertise for local clients.
Mm-hmm. We know you are an expert on income investing. So with interest rate so low in recent years, what do you think the role of bonds is in individual investors' portfolio?
Sure. It's one of the biggest challenges that global investors have in the current market environment.
Yeah.
It's not just the low level of income or yield. It's also that investors globally have become used to the idea that equity prices or risk prices move in opposition to riskless or high quality fixed income prices. So you think about a time of real volatility, equity prices may fall, but high quality bonds rise. Because yields are so low, there's very little room for that to continue to occur. And as we discussed earlier, it's actually rising yields that are creating some volatility around equity prices these days. So it's not just the low level of return, it's actually the correlation that's changed. The good news is global fixed income markets have expanded dramatically over the last several decades. And in my view, there will continue to be moments of excellent opportunity, especially when you have volatile interest rate markets leading to volatile credit markets. And that's where we are built to excel as a firm.
Mm-hmm. We know the classical bond and equity portfolio called 60-40. So in today's environment, do you think it still works well?
I think it's much more challenging. As I said, the big part of that 60-40 allocation is negative correlation between risky assets and riskless assets. But additionally, one more basic premise around the 60-40 allocation is simply portfolio balance. And there are a number of ways to achieve portfolio balance that aren't just about stocks and bonds. We talked about one earlier around kinds of stocks. Having some element of growth equities, some element of global equities, as well as some element of quality or dividend producing equities provides balance in your equity portfolio. Interestingly enough, those same dividend producing and cash flowing equities lower the burden in finding income and yield from your fixed income allocation. So there are ways to be thoughtful around achieving balance, both within your portfolio at one time and also being able to be opportunistic over time.
Mm-hmm. How about, using it in emerging markets? How could it be optimized?
So emerging markets, it's funny, emerging markets as a concept, I think the most important thing that I continue to learn over a number of decades is that emerging markets kind of contains everything, right? Mm-hmm. So the Chinese market is globally considered an emerging market. Mm-hmm. Frankly, I'd rather fly into the Shanghai airport than the New York airport, but in any event, China is lumped in with that index with Turkey or with South Africa, which not only doesn't make sense from a level of development standpoint, but also doesn't make sense relative to drivers of the economy. So I think one of the most interesting elements of balance within emerging markets is simply understanding what are the drivers of each economy. It may even make some sense to say that China is a separate entity, much more production-oriented, much more developed, much more of a commodity importer versus exporter, a number of different elements that make it different, but also allow that market to provide an important part of a global investor's portfolio.
Yeah. When it comes to dividends, many individual investors here don't seem to value it too much. So would you like to give some advice or tips on dividends, and how do you think dividends could help when pick stocks?
I think that the question is, will dividends become be important, and what role do dividends play in a portfolio? I have found that dividends provide a few different elements that are very important for investors. The first is cash flow, which, as it turns out, is in high demand. The second is an allocation generally towards quality. So companies that are producing enough cash in order to be both willing and able to pay those dividends provide a certain element of quality to a portfolio. But most of all, in this current environment, it allows investors to focus less on reaching for yield and reaching for risk in their fixed income allocation. And so I think that there's a place for dividend investing regardless of the market that you are in. Our research shows actually that investors that invest in companies that pay a high dividend over many, many years, not only do those companies pay you more, but they actually grow faster. And they grow their earnings faster because they're disciplined with their capital. Again, it tends to lead to a higher quality portfolio. So I think that's the kind of portfolio that can withstand a lot of bad weather.
Mm-hmm. Like you just mentioned, we also know you mentioned China Mobile in your book, and to compare the high dividend yield with growing dividends. So would you like to share with us your analysis, and what is your conclusion?
Sure. So I wrote that book at least a few years ago. And so the specific example, while interesting, is more about a broader lesson that I have learned, which is high dividend yield is actually not as interesting as some element of dividend yield that grows over time. And that's really a lesson about compounding. And it's really a lesson about the yield that you initially buy, but then ultimately the cash flow that you ultimately get. And if companies are able to grow their income over time, if their cash flow generation grows over time, ultimately that not only provides you with a better total return, but it even provides you with, after not too long, a better income return than simply trying to maximize yield. As is true with many things, focusing only on one metric, in this case yield, gives you a less than ideal outcome.
Many of today's internet stocks or tech stocks don't pay dividend. In some cases, it's because the company isn't profitable yet. So how do you think of those kind of stocks?
Sure. So that's the hopes and dreams, right? Where that's an important part of a portfolio. Equity markets do have the ability to fund innovation and to anticipate long-term growth. And there should always be in every portfolio, at least as far as it can withstand risk, some element of exposure to upside and to positivity. And that's what growth stocks represent. I would simply say that, again, today, the shift is a little bit from hopes and dreams to cash flow today. And so that's sparked some real questions about what are the valuations of those growth names? Or perhaps more importantly, how long will I have to wait for those companies to grow into their very high valuations? I've lived through a number of market cycles to include the tech bust in the United States a little more than 20 years ago. And every day you walked in and stocks were down. And so it felt very painful as the system deleveraged. But out of that investment and out of that rubble came some really wonderful world-beating companies. And I would expect that to occur again in this cycle.
So let me be specific. When you pick stocks in China, how do you think of the dividends, and what's the difference with those dividend-paying stocks in the U.S.?
Sure. So there's some very similar elements. In other words, if the company is generating consistent cash flow to pay an excellent dividend, then that's valuable, especially when that dividend, that cash flow, is significantly in excess of what an investor can get in the bond markets. Now, equity markets are more volatile than bond markets, but if I get interesting growth and dividend together, that's a valuable long-term investment. I think there are a few differences. One of them is that the characteristics and sector allocations of markets, for example, in China and the U.S. are different. And some of the more industrial companies in China have a different character in the context of how much dividend they're willing to pay or how much shareholder capital they're willing to return relative to the United States. Frankly, globally, there are differences from the United States in that the United States taxes dividends twice. It taxes on the company level, and then it taxes the end investor that receives those dividends. So in some cases in the United States, companies are less incentivized to do dividend payments than they are to buy back shares, where that's less true globally. So everywhere there are differences, there are sort of nuances that are important to navigate. But I think a very key tenet is if the company is consistently generating cash flow and cares enough about its shareholders to return some or a significant portion of that cash to those shareholders, that's generally a high-quality company.
You said long-term, and stock pickers at your firm adhere to a bottom-up approach. So my question is, should stock pickers ignore those micro factors or trends altogether?
So I think it's impossible to ignore macro factors altogether. As an example, in global investing, you can invest in the same business model in two different geographies, and macro factors can swamp, currency alone can swamp returns in one direction or another. So I think it's important to be a student of macro factors, especially in the context of how it can affect companies' business models, especially from a vulnerability standpoint. So an example would be a company that has significant costs in one currency and receives significant revenue in another currency. That's essentially a macro risk that as a fundamental investor you have to be aware of. I think another element to macro factors with regard to portfolio construction, not just picking stocks, but putting that together in a portfolio, it is possible to minimize and control for, at least to some degree, factor exposure, say value or growth or quality or momentum, even factors in the context of interest rates and currency movements. So it's important to think about those risks, but models that give you some of that understanding or insight are imperfect, and it's always more art than science. So essentially, it's important to understand your portfolio at an individual level, and also to understand it at a portfolio level from a risk standpoint and a return standpoint. One element that we always adhere to at Thornburg, again, relative to what we're trying to achieve in a portfolio, exposure to growth, exposure to dividends, et cetera, is within that balance. We don't want to have only one kind of company such that we're exposed to only one kind of risk. We want to make sure that we have a balance of different kinds of companies and different risks so that we allow our individual stock picking to achieve the excess return that we're looking for.
Mm-hmm. I've learned another thing about your firm is that you have your headquarters in New Mexico, away from traditional financial centers. And you say this makes you think independently and objectively. So what does it mean to be independent thinking in investment industry?
It's a terrific question, and it's nighttime now, but if it were day, I would open up the shades behind me and you'd see a giant mountain covered in snow. I think the critical part of investment is thinking differently is important for success. You have to do things a little bit differently in order to achieve a different result. And as you know, if you do what everybody else does, you'll end up with a less than excellent result. I think one piece of this has really been over the 40 years of Thornburg's history. What we've seen is that information flow, the ability to get information, has increased dramatically. So when we first started the firm, we didn't depend on having more or better information than someone else. We would have had to be in New York or London or Hong Kong to do that at that time. As information, we've depended on having better perspective and taking our insights and putting them together in thoughtful ways that understand a broader set of inputs. In other words, we were less focused on knowledge and information and more focused on perspective and wisdom. As information flow and its ease has increased dramatically, we would never have been able to have this conversation even 10 years ago, let alone 40 years ago. As that information flow has increased dramatically, firms that focus on having a little bit more information have seen their edge go to zero. Whereas for us, it's more about taking that information and putting it together in interesting ways. I won't tell you that having the firm grow up in New Mexico outside of a major financial center was determinant in that approach. But I will say that in times of stress, and you look outside and the sun rises over the mountain, you do have a little bit different perspective than in a major financial center.
Mm-hmm. So please let me ask you an additional question. When Fed raised the rates, there will be some concern that it would derail the recovery of U.S. economy. So would you like to share with us on this?
Sure. I actually, with a little bit more time, it's nice to be able to get into some depth, which is, I think one of the biggest problems that the Fed has today is that they have either on purpose or inadvertently taken responsibility for saving the world. And they've stayed too loose, too accommodative for too long. Now the Fed is tightening, being behind the curve, the Fed is tightening. And I believe that if the economy is going to slow and there are going to be major problems, it's not just because or even primarily because the Fed is raising rates. It's because the Fed has stayed loose for too long and created a much more challenging credit cycle, a much more challenging business cycle than had they raised rates and accepted a slightly lower rate of growth earlier. The challenge now, however, is because the Fed took credit for the recovery, they will also take the blame for a downturn. And that, to me, is a broader, more philosophical and more challenging issue for markets that I think not just extends to the Fed, but actually to global policymakers. So I don't think the Fed is necessarily the one that will derail the recovery. I think and cause a recession. I think it's simply that the market and the economy have gotten too hot, and the cooling and deleveraging that naturally will occur regardless of where the Fed is, but certainly with the Fed's help, will be that deleveraging will really be a challenge that we'll see, perhaps not in the beginning of 2022. I don't expect it then, but perhaps towards the end of 2022 and maybe into 2023. And that's one reason why I'm very comfortable forecasting volatility.
Mm-hmm. And that's all of my questions. Thank you for sharing. 以上就是今天采访的全部内容，感谢您的观看。您也可以在各大新媒体平台上关注《证券市场红周刊》的更多内容。再见。